This is Tom Glatt with Glatt Consulting Group. And in this Insights Brief, we're exploring the credit union industry health score for the third quarter of 2023. If you're unaware, Glatt Consulting is a boutique consulting firm serving credit union leaders. Boutique means we engage with a small collection of clients, specifically in the areas of credit union strategy, organizational structure, leadership, and governance. We were established in 2006 and possess a hard-earned awareness of the unique challenges and opportunities facing the credit union movement, including what it takes to be a healthy, high-performing financial institution. Our credit union industry health score is a model we created and use to evaluate the health score and performance of individual U.S.-based credit unions and of the industry overall. We calculate scores for 17 different key ratios for every U.S.-based credit union to determine their overall health, and then we use the individual credit union results to determine scores for the industry. With regard to scoring, our model is based on a 10-point scale, with 10 generally indicating high performance and health, 0 generally indicating low performance or health, and 5 indicating performance that's average by industry historical standards. Now, note that I said generally with regard to low and high scores. I did that because in the banking industry, you sometimes don't want high scores in certain areas, depending on things like your balance sheet strategy, your strategic plan, and even the environmental influences that you have to contend with. So what's the latest health score for the industry? It is 6.141. Now, if you recall what I said just a second ago about the score range, this means that the industry as a whole is operating above average. That's certainly a good thing. However, this latest score represents the second straight quarter of year-over-year decline. While the industry is above average in health and performance, it is slightly less healthy and less high-performing than it was in the same period last year in 2022. Why? Well, it's the same three drivers that we saw driving scores down the last quarter: credit quality, liquidity, and growth. By the way, before we get into the details here, if you're not a current HealthScore subscriber, you can get your own free copy of the report that I'm sharing in this Insight Update here on our website at glattconsulting.com HealthScore. And if you're a credit union leader, which includes staff, board members, committee members, and the like, you can subscribe for free to get a report that's customized to your credit union, scores for your credit union in addition to the summary data I'm sharing here, and comparisons of your credit union to asset peer groups, statewide peer groups, and to the extent we can determine it, your local peer group. Okay, the first collection of data points that I'll share from our most recent report is truly my favorite page. It's our year-over-year percent change report. This shows us in number and color format what the underlying trends are for each of our 17 score components and the health score itself, which is the far left column. With regard to the colors, as you might expect, red indicates a negative or negative percent, I was going to say bad, but negative percent change in scores, while green represents a positive percent change. Note that the latest figures are at the top of the page, and at the top there is a whole lot more red than at the bottom of the page, which includes scores as far back as 2018. Consider the third quarter of 2018. There were only 3 metrics or scores that have red boxes down there, but for the third quarter of 2023, there are 11, including our overall health score. Overall, the industry is healthier today than in 2018. We had a better score, have a better overall score now than we did then, but many more scores currently are trending in a negative direction as compared to the same scores in 2018. While the colors are important, so too are the numbers in the boxes and how they relate to the numbers that came before them. Take the DL column, for example. I've got it boxed in here. That's our delinquent loans to total loans score. We'll use that as an example. We saw the first of the most recent red boxes pop up in June of 2022. In that whole column, you can see a red one about 2/3 of the way down, and then as you get closer to the top, you see a group of red. Anyway, that was the first recent box that popped up, June of 2022, and we see in that box a year-over-year score decline of 2.81. The number after that, September 2022, was also a negative of 3.10. Then we had a negative 441, negative 369, negative 399, And this most recent quarter, September 2023, the third quarter, was a 6.13 decline, and that's a decline in year-over-year score metrics. What this shows, and this is why I say you want to look at the the numbers in the boxes and what precedes current numbers, is that for this particular score component, we see deteriorating credit quality. The score year over year is getting worse. So when we see that kind of trend, we're factoring in the seasonal influences, but also looking at the trend over time. On the other hand, the CS column, and I guess it's on the same hand, but in a different context, if you will, we find our cash and short-term investment score. That's cash and short-term investments to total assets. Liquid assets, our access to liquidity, if you will, easy liquidity. That score went from negative 21.98 in the first quarter of this year, because we had a lot of money running out chasing higher yields and investing in Treasury Direct and the like. So negative 21.98 to a negative 13.23 in the second quarter, and finally to a negative 7.13 in the third quarter here in 2023. So while still negative, kind of like our DL column, this indicates a slowing pace of decline, meaning that credit unions may be seeing some light at the end of the tunnel when it comes to the challenges of maintaining liquidity. Conversely, looking at the DL column, it's the tunnel getting darker, if you will. Like I said earlier, the primary drivers for the year-over-year score declines are credit quality, liquidity, and growth. The credit quality columns, if you want to look at the whole report here, include the DL, which are, again, delinquent loans to total loans, the CO column, which is our net charge-offs to total loans column, and the Texas ratio, or the TX column. The TX ratio measures our buffer for rising delinquencies, looks at long-term delinquencies and other real estate owned, divided by our allowance for loan loss account and our capital, and this also can serve something as a loss coverage ratio. With the exception of TX, the Texas ratio, which shows an improving trend, delinquencies and charge-offs, DL and CO, show accelerated declines. Our liquidity columns include CS, RS, and LA. CS is cash and short-term investments to total assets, like I just mentioned. RS is regular shares, or our core savings accounts, to total shares and borrowings. And LA is our total loans to total assets. The CS and RS, cash and short-term investments and regular shares to total shares and borrowings, both showed declines, though again, you'll note that the pace of decline for the CS, the cash, slowed relative to prior quarters. This is likely due in part to credit unions investing longer term. And you'll also note, and this is another likely due in part to, you'll note that the LA column, loans to assets, is an outlier in that while CS and RS are red, loans to assets in green, meaning score improvement year over year. If you look closely, though, you'll see that the pace of score improvement has slipped some, a trend I attribute to the growth columns, which again is why I say we refer back to that. Each of our growth columns experience year-over-year score declines, and the two scores that influence that loans to assets and ultimately sort of help manage that cash, the need for cash and short-term investments to be liquid, kind of come back to the asset growth and loan growth columns, AG and LG, they're on the right-hand side. Credit unions have been working in recent months to tighten up lending standards a little bit, both to address liquidity challenges, again, to kind of make sure they've got enough money to handle the most important critical demands for loans, but also to head off escalating risk. Again, if we see delinquencies and charge-offs rising, then it may make sense to tighten up on loans just so we don't double up on risk. So we're seeing that intentional strategy, if you will, drive down some scores there and loan growth, and that affects that loans to assets. Now, finally, in the growth section there, membership growth scores year over year turn red after 4 months, or rather 4 quarters of year over year score improvement. So you see that green on the far right-hand side, and then we hit the red. Competition is heated up, so I'm really not surprised, right? It's just getting harder to attract members because there's an abundance of choice out there. So anyway, as I stated, this page shows year over year percent changes in our scores. The question I would ask now if I were you, what do the scores themselves look like? Where do the scores sit? And for that, we go to a different page. This page right here, it shows us But I want to say before I get into these numbers, recall that I said 5 indicates historical averages. The color coding on this page is a little different than our year-over-year percent change page. The color coding here uses green to identify scores 5 or above, yellow indicates scores below 5, and red indicates scores that are well below 5. So anything green or above are areas where we're doing well, we're either at average or above, and then yellow and red would be areas that are lagging a little bit. Now, when I look at this page, every time I get a new report for a quarter, I'm immediately drawn to the aberrations, if you will, the ones where we see the uniqueness of color relative to all the other boxes on the page. In this particular case, we certainly have that CS column, cash and short-term investments, but our growth columns really are where I'm paying attention right now. Asset growth, loan growth, membership growth. Candidly, I'm not as concerned about that cash and short-term investment column and the negatives we're seeing, again, because we saw some, the pace of decline is slowing. And frankly, if we're otherwise stable and healthy and we're not blowing the doors off with loan growth when we've got rising delinquencies and charge-offs and liquidity problems, then, or not problems, but challenges, I should say, then I'm not worried about the cash and the liquidity access because it's not that high of demand as it was, in this case, say a couple months ago. But on that note, and as I mentioned, credit unions have tightened up to a degree on the lending side, so the lower scores for CS are more than likely okay because we're not driving excessive loan demand. What concerns me more is the continued challenge with solid membership growth, and you see I've boxed that in more on the right-hand side. Part of the underlying driver for membership growth challenges is just that heightened state of competition that I mentioned before. I mean, we got competition coming from all types of institutions. We got banks, of course, other credit unions, and here's an aside. When we do a competitive analysis, when we a competitive survey of our clients for planning, and what we ask who are your top competitors, the top 5 kind of average competitors across all our clients are credit unions, followed by other types of financial institutions. So there's a greater awareness of and degree of competition between credit unions. But anyway, we've got banks, credit unions, fintechs, buy now, pay later resources, and the like, all vying for the attention of our members. That's certainly one important driver for the challenge that is membership growth. The other driver, though, one I find more of a problem than simply heightened competition, is how many credit unions struggle with defining, understanding, and therefore properly relating to the marketplace that they want to grow. This here is a business model problem, and some credit unions just don't seem to be up to the task of constructing a future relevant business model. Consequently, I think for them and for maybe the industry as an aggregate average here, consequently for them and the industry, growth and membership is likely to remain an issue. Okay, so on this chart, the final thing I'll point out, and it's a trend that I made note of last quarter, is the scores for credit quality. Now, let's stay with our charge-off score, or the CO column. Remember that the year-over-year percent change in the third quarter was negative 12.4, but we come back to this and we see that the actual score is still above average at 6.71. What this means is that while charge-offs are increasing as evidenced by the year-over-year score decline, we're still doing okay relative to historical experience, right? The score's above average. That said, scores generally moderate to the average over time, and this is likely where charge-offs are headed, meaning we're going to push that back to around a score of 5. And if that's the case, I would expect to see continued declines in our charge-off scores and our delinquency scores as well. Now, I love the data here. I could spend all day diving into the weeds, but as I said at the start, this is an insight to brief, not an epic saga. So let's move on to our final bit of HealthScore material, a look at the leaders list. The credit unions you see here are the top 4 credit unions, at least as to the third quarter, and they are truly at the top of their game. You can kind of see the 4 we have up here, those Romecraft Employees, Capital Area, Meridian, Mississippi, Hope. These credit unions here are the top 4. Out of all 4,000 and change credit unions, these 4 have the highest scores. Let me point out a few that I find interesting. First is Romecraft Employees. They have the highest health score of all credit unions. They're number 1 on the list, so of course I'm going to find that one interesting. What else is interesting about them is that they're not a big credit union. $22 million in assets. And again, I think I've made this comparison before. You look at Citibank, Wells Fargo, you're talking trillions of dollars in assets. This credit union's $22 million. There are probably people at those big institutions that have $22 million in total account relationships as individual people. But this credit union, they have been stellar. In fact, the interesting piece here is they've been stellar since CEO Diane McCoy was named CEO back in 2015. Prior to then, the credit union had successive years of zero scores for loan and membership growth. And by successive, I mean with very few exceptions, they were predominantly scoring zero in membership growth and many times, most times in loan growth from 2003 until 2015. Since 2015, with the exception of the 2 quarters deep in the COVID pandemic, their membership and loan growth scores have been well above industry averages. And you can see they've got a good score of 6 right now for membership growth, 9.5 for loan growth on the chart here. And that equates to 3.5, a little over 3.5% membership growth and 17% loan growth. Really good year, a really good quarter, I should say. The second one I want to point out is a little bit further on the list. They're on the next page following the one that I just mentioned, and that is Western Division in Williamsville, Kentucky. Starting in 2020, they really turned membership growth around. And again, there's something about the leadership change there and the change in strategy. They were above average for quite some time, as was the other credit union that I mentioned, Kraft. But in any case, particular to this one, Western Division, they really have been consistent in membership growth all the way through COVID until now. And you can kind of see their numbers. They've got a 12% membership growth and a 36% loan growth. So they've got scores of 10 in each of those areas and are scoring very well. The final credit union I'll point out is Eastman out of Tennessee. They're our largest one in the top 20 list at $7.8 billion. What's amazing about them is that since 2003, so that's 20 years, they have only had 1 quarter where their membership growth score was 0. And to get a 0, you have to be basically at growing 0 or shrinking in terms of membership. So there is only 1 quarter where they experienced some sort of year-over-year, or rather a decline of any kind in their membership growth. A lot of times when you see that happen, it's just because of account cleanup. So anyway, very impressive there. And right now, let's see. Their membership growth is 6.98, and that's against 320,000 members. So it's impressive whenever you see large credit unions with multiple thousands of members continue to grow, because every year you need to grow many more people just to have the same kind of growth. Now, those are only 3 of the many interesting credit unions on our leaders list. I think it's fascinating to dive in and explore how they present themselves to the marketplace. So I encourage you to go to our website and get your own report. You can get your own free copy of this report, the one I shared here, on our website at glackconsulting.com/HealthScore. And in that report, you can see the full top 20 credit unions, which includes quite the array of diverse credit unions out there. And like I said, I encourage you to take a look at them. They've got the website address on the report there, and you can kind of click in and see what they're doing and how they're presenting themselves to the world. And as I said, if you're an individual credit union or credit union leader, whether you're on the board, a member of management or staff, or on some committee, you can subscribe for free to get a similar report, but one that includes your own credit union data. So that's it for this Insights Brief. If you have questions about credit union health and performance, please do let us know. We can be reached at hello@glackconsulting.com, or you can hit the website and complete our Contact Us form right on the home page and any other page for the most part as you browse the site. Once again, I'm Tom Glatt with Glatt Consulting. Thanks for watching.